Ever wondered how to get paid without lifting a finger, truly making your money work for you? Get ready to unlock the ultimate secret to consistent passive income. Dividend investing. Forget your old money rules, we're diving deep into the brain rot edition of making your cash work for you, generating wealth automatically 24/7. So, what exactly are these legendary dividends everyone's hyping up? Think of them as regular cash payouts from companies directly to you, their valued shareholder. These aren't just random gifts, they're a direct share of the company's profits, typically paid out consistently every quarter, providing you with a reliable income stream. Companies that consistently raise their dividends often signal robust financial health and unwavering confidence in their future earnings, a significant green flag for any savvy investor. However, remember that companies aren't legally obligated to pay dividends indefinitely and can reduce or even eliminate them at any time, especially if their financial situation deteriorates. Now, how do you find these dividend gold mines? It's not just about picking random stocks. You absolutely need a well-researched strategy to succeed. First up, we analyze dividend yield. This crucial metric shows how much a company pays in dividends annually relative to its current stock price, calculated as annual dividend per share divided by stock price. A seemingly high yield can be tempting, but always check if it's truly sustainable and not just a deceptive red flag resulting from a rapidly declining stock price. Next, we examine the payout ratio. This is the percentage of a company's total earnings paid out as dividends. A lower ratio generally means more room for future dividend growth. You want companies that strategically reinvest a significant portion of their earnings back into the business for future expansion, rather than just giving away every dollar as dividends. Financial stability is key. Always look for companies with strong balance sheets, manageable low debt levels, and consistent, predictable revenue streams. Specifically, a current ratio of 2 or higher is a good indicator of a company's robust ability to cover its short-term obligations, calculated as current assets divided by current liabilities. Also, check their dividend growth history. Companies that have consistently increased their dividends for 5 years or more are often solid, reliable bets for long-term income investors. And don't forget sector diversification. It's vital to spread your investments across various industries like utilities, consumer staples, and real estate investment trusts, or REITs, to significantly reduce overall risk. All right, time for a quick brain rot twist. Imagine dividends not just as money, but as those epic loot drops you get in your favorite video game, appearing regularly. Every quarter, your chosen company drops some sweet cash directly into your account, just for holding their stock. It's literally like getting bonus XP and leveling up for doing absolutely nothing. Now let's talk about the ultimate cheat code, the secret weapon for exponential growth. The power of compounding through a dividend reinvestment plan, commonly known as a DRIP. A DRIP automatically takes your cash dividends and uses them to buy even more shares of the exact same stock, often commission-free, accelerating your ownership without extra effort. This continuous reinvestment is the magic behind compounding, where your earnings start earning more, making your entire investment grow exponentially faster over time. With a DRIP, both the total number of shares you own and the dividends paid per share are growing simultaneously, effectively multiplying your benefits and accelerating wealth accumulation. Building your dividend portfolio requires a well-thought-out strategic approach, a clear plan, and careful execution, not just blindly throwing darts at a stock market board. First, clearly determine your specific investment goals and honestly assess your personal risk tolerance. Then, decide how much of your portfolio you are willing to allocate to dividend stocks. Consider individual stocks, or for instant diversification and ease, opt for exchange-traded funds, or ETFs, which are specifically designed to specialize in dividend-paying companies. It's crucial to diversify your holdings across 20 to 30 different companies, spanning various sectors such as utilities, real estate investment trusts, consumer staples, and healthcare. And always regularly monitor your investments. Dynamic market conditions, economic shifts, and individual company performance can significantly impact future dividend payouts. While dividend investing sounds like a golden ticket, it's not without its challenging boss battles and potential pitfalls. Let's dive into the inherent risks. Market volatility means even the most reliable dividend stocks can experience significant price drops, potentially eroding your initial investment's capital value. Companies can also cut or suspend their dividends at any time without much warning, especially if their financial health unexpectedly takes a severe hit. Sector concentration is another significant risk. Putting too many of your investment eggs in one industry basket can dramatically increase your portfolio's overall volatility. Dividend stocks also tend to have slower capital appreciation or price growth compared to high-flying growth stocks, which represents an opportunity cost for investors focused on rapid gains. And don't forget tax implications. Dividends are subject to taxation, so it's essential to understand the difference between qualified dividends, taxed at lower rates, and non-qualified dividends. For young investors, prioritize consistent dividend growth over chasing super high starting yields. Focus on investing in durable businesses with a proven track record. Always reinvest those dividends using DRIPS to maximize compounding. Consider dividend-focused ETFs for instant diversification. And critically, learn to avoid those often tempting but unsustainable high-yield traps. Always focus on the total return of your investment, which is the comprehensive sum combining both the regular dividends you receive and any capital appreciation from the stock's price increase. All right, time for a quick brain rot poll. Do you honestly think meme stocks, known for their wild swings, can actually be reliable dividend investments? Cast your vote, yes or no. While meme stocks are known for their social media momentum and extreme volatility, they are generally not considered reliable or sustainable dividend investments due to their speculative nature. These stocks are highly speculative and driven by sentiment, meaning investments in them can lead to substantial and rapid losses if your purchases or sales are timed incorrectly. There's even contradictory information about the dividend history of the Roundhill MEMA ETF, with some sources claiming payouts and others none, highlighting the critical need to always verify your sources. So, while the hype and social media buzz around meme stocks can be incredibly real, the actual, consistent dividend payouts you might be expecting very well might not be. Dividend investing can be an incredibly rewarding and powerful strategy for young investors who are seeking to build consistent passive income and achieve significant long-term wealth creation. By understanding the fundamental principles, diligently identifying suitable dividend-paying stocks, and implementing a disciplined, strategic approach, you can effectively harness the immense power of dividends for your financial future. Are you truly ready to make your hard-earned money start working tirelessly for you, generating income while you live your life? Then don't just watch this video, act on this knowledge now. Make sure to subscribe to Money Code Breakers right now for more brain rot finance hacks and cutting-edge investment strategies. And definitely check out the link in the description below for our recommended brokers.